Good evening, everyone. My name is Scott Lurie with F Street. I'm so excited to be with you this evening. Tonight is one of those webinars that I'm pretty excited that we are able to produce and share with you, our guests this evening, as well as on our YouTube channel. The reason it is so important to me is the X's and O's of real estate is one of those misnomers that a lot of people make investments, but when you get down to asking them what they're investing in and why they've made that investment thesis, most people it falls on deaf ears, or the response is pretty crosses a bunch of different standards of expectations, but none of them necessarily make all the sense in the world. And so tonight, I really wanted to break down and evaluate how we make investments, how we make investment decisions, the metrics we use, our real estate slang that we talk about, that you evaluate when you invest in, and all of that coupled together allows you to consider making an investment. So super excited to be with you. F Street is an alternative real estate investment firm. We focus on building long-term wealth for our investors through passive income. We do this through alternative investments. One of those words that we're catching today that people always get misnomered by is alternative investments. Alternative investments simply means alternative traditional stocks and bonds and mutual funds that you have are since you were in school or grade school, I've always heard about a checking account, a savings account, a CD, a stock, a bond. No one really talked about multifamily investment, industrial investment, private debt investments, but at F Street, those are our categories. And I really have enjoyed using our newest logo, Bullish. We're bullish on all of our alternative investment platforms and super excited to continue to share those opportunities with you. As I said, we focus on three categories. We're a multifamily investor, we're an industrial investor, and we're a private debt fund investor. Some people pick all three verticals to invest in that have invested with us. Some are just into our private debt fund. Some are learning more about other investments, which include the multifamily and industrial, and those categories have their own language, and we're going to break all that down here tonight. My amazing and mighty team. As I said, my name is Scott Lurie. I am the founder of F Street. I founded F Street almost 20 years ago as a real estate firm. We started in multifamily and private debt, 2009. We've been doing real estate since 2003. Really excited to be here. My team continues to be the most mightiest team out there. I don't know if you had a chance to speak to anybody, maybe Mitch, maybe myself, maybe any one of our other investment relations folks, but it's super great team, and I'm really proud of everything that our team continues to do. A little bit on our portfolio. Excuse me. We have multifamily projects that span basically the United States. We build and buy multifamily. The stuff that we're building in southeastern Wisconsin. Here's a couple of our projects. Coast, which just came online, Greenlink, which is in Brown Deer, Wisconsin, Tannery Falls. We also have a portfolio over here of hotel to multifamily conversions that we've done in Jackson, Mississippi, and Albany, New York, and Tyler, Texas, and Lubbock, Texas, and Akron, Ohio, and Milwaukee, Wisconsin. And we're just started and just completed an $11.3 million raise here in Brown Deer, Wisconsin. And we are almost already done with the Emory here in West Bend, Wisconsin. So those are ground up multifamily opportunities. A little bit about our industrial portfolio. We build the best industrial around, and when I say it's the best, we focus on architectural appearance. We build 32 to 36 foot clear. It's all Class A industrial, and we build these amazing industrial parks. This is a picture of Southport Commerce right here. You can kind of see what this looks like. We just finished a Fortune 50 built-to-suit distribution center for a company. It's unbelievable. They're putting in another X millions of dollars. We do buy legacy industrial as well, and that's some of our other portfolio that we already own. So a little bit about us. We've got 1,155 units with almost $200 million. We've got 2.1 million square feet of industrial. I just got another 900,000 square feet of industrial under contract 5 minutes before I joining you this evening. So super excited to share that with you in the coming days. And we're working on so many new investments. We're closing on Friday on 198,000 square feet of industrial, which is Granger, which some of you have already participated in or are interested in participating in. So we're continuing to bring amazing opportunities to the investment community, and we can't do it without the support of all of you investors. But it's most important to me that we are delivering above market returns in alternative space, and we really are proud of what we're doing. So thank you for at least tuning in tonight to educate and better yourself. If you have any questions during any of this, please put it in the chat, and Peter will moderate with me this evening, and we'll get you those answers. If I don't have the answer for you tonight, or the question is a very complicated one, excuse me, I will ask that I can get back to you tomorrow. So we talk X's and O's, right? Football talk, right? This is football talk. The X and O's is a real estate investment, right? So how many people have made a real estate investment, or better yet, how many people have invested in a mutual fund, or how many people have invested in their Roth IRA or IRA and have no idea what they've done, right? I'm going to project at 12.2, blah, 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 and I don't even know what I'm investing in. I made an investment in it. Most people, a lot of people. I want to invest in a real estate transaction with a 17.8 IRR and a 2x equity multiplier. And most people say, what the hell are you talking about? And then they ring the bell and they show up at the table and they make an investment. That happens so often. How many people have made an investment in real estate and they don't know what they've invested in? How many people have invested in their bond and don't understand what a double tax-free versus a triple tax-free versus a mutual fund, which is a front-loaded or a rear-loaded or an annuity, or how many people have made those investments? Everybody has, because the problem is the way that people talk in the jargon that people mention never really makes sense to anybody, but we're trained to make those investments, right? But they don't tell you the downside exposure. So why are we doing all that? Well, my job, my belief is I want you to really understand the X's and O's of what we're asking. I want you to dig in and understand it. Because what I'm doing in real estate, hundreds of people around the country are doing real estate. Some of their projections don't work out. Ours, fortunately, have worked out. But because I think we look at the pro formas and the X's and the O's in a whole different fashion to give you, the investor, a real light and a real understanding of what happens. So what I'm here tonight to show you, because a lot of people ask this question but never really ask it in a way I want it to be asked. And I want it to be asked in a specific way so you, the investor, can actually understand what you're investing in and what implications it's you and how do you use that to make investment decisions. Because that's important. I want to invest in Apple because I use an iPhone. How many people think that? I even buy Amazon shares because I buy Amazon product, right? Everything's delivered to my house on Amazon, so I want to be a shareholder of Amazon. I want to buy Danner because I don't even know what they do. I'd like Boeing, but I didn't like when the door fell off Boeing, so I'm going to take my money out of Boeing, but Boeing stock is back to where it was, and what happened? I don't even understand. So what we're trying to do is create a competitive market. I want to decode the investment concepts for you. I want to get rid of all the nonsense on the side, and I want to give you the skill set you have to be able to be dangerous enough to evaluate the investments and say, yes, it's good for me, my family, and my investment future, or it's not. Knowledge, at the end of the day, is power. However you want to look at it, the smarter you are, the more you learn, the more you know, the better off you are. It's that simple. So, how to potentially defer capital gains investment opportunities. Multifamily, 12.5, cash on cash returns. Here's some of these. 30% AIR, 4x multiplier. My butt, that's a lie. Targeted compound interest rates, compound returns 11 to 4%. What does compounding mean? Your path to 24.56 projected IRR with cash flowing RV parks. How many have seen all of this nonsense on the internet? I have. I see it every night because I'm an investor. You've seen it because you've visited one of our sites. Investing in Tampa and Texas housing shortage, 2.2x equity multiplier. I'm assuming when you look at those, you're like, oh, there's pretty pictures, there's some numbers in there. I should maybe take a look. But do you know what they mean? Of course not. Some of you do, of course. Some of you understand some of it, of course. I live this world. If some doctor told me that they're going to go do something to my this and do something like that, I kind of understand that I might be under some anesthesia and they're going to do something, but I don't understand the technical, mechanical side of being a doctor. And you as a doctor or a lawyer on the other end, I don't know your business. So how would you know my business? You've got great trust in the system, right? How many 401k owners do we have? How many IRAs? Do we have a 401k and IRA holders? Yep, we got those. Okay. Do you know what's going on in your 401k or IRA? Of course not. You are complicit, most likely, unless it's a self-directed one, where you are just part of the system, right? You've been told wherever you went to school or wherever you went to school or wherever you got your first job, wherever you started, start a 401k. It's really good for you. Okay. Let's talk a little further. So terms to know, right? So here are the key concepts, right? This is all of the slang language that I talk about every single day in my life. IRRs, this is one of the top ones. Equity multipliers, COC, cash on cash, right? Preferred return, NOI, DSCR, TIF, cap rate, cost seg. I can go through every one of these. But to understand what they are, the implications to you, the investor, is important. But most people talk about this, right? IRR, equity multiplier, cash on cash return. Let's just start there, right? Let's talk about preferred returns. Let's talk about NOI, net operating income. We're going to get into the X's and O's there. But understanding what these mean simply will impact your returns. It will simply impact your risk. Is my risk low or high? If I have a low cap rate, in theory, my risk should be lower versus a higher cap rate where my risk is higher. We'll dig in. Do we have any questions in there? Okay. So simplify decisions. Know your metrics. I can tell you, everybody, that we create what is called our buy box. Okay? And you, this is me. You, the investor, this is the investor, should have your buy box. Okay? What is your buy box and what is my buy box? They should all be together. So you as the investor should understand what is an acceptable IRR. You should understand what an acceptable equity multiplier is. And for the love of the world, understand at least what your cash on cash or your preferred return is, so you know what you're earning in terms of a return on your money. Remember, you're doing an investment to make a return. This is not a novelty investment. It is your retirement. It is your future. It is your legacy. It is your cash flow to your kids. It is your cash to yourself today. We have a lot of investors. I have a lot of investors that invest in my private debt fund, and they use the 10% return they get to fulfill their lifestyle. My lifestyle costs me $10,000 a month. I want to invest 1.2 million, and in exchange for that, I'm going to pay you, F Street's going to pay you $10,000 a month. Your principal's with us, you get $10,000 a month, you dig into your principal zero, and you live your normal lifestyle. Our focus, as you can see, is right there. Oh, what is your focus? Let's start paving the way. Start thinking like an investor. What is your focus? Are you risk adverse? Are you more risk tolerant? When you go sign up to a Charles Schwab, or you go sign up at E-Trade, or you go sign up at Wells Fargo, they ask you, what's your risk tolerance? How long do you need this money out for? When are you coming back? Do you want to invest $1 million? And if you do amazing, you get 2 million. If you do terrible, you get 0. That would be a terrible risk tolerance. That'd be so risky. Who would ever say yes to that? So one of the largest definitions, as I said, we use is IRR, right? This to me is a statement of what is the internal, rate of return. Think about all of this over the period of time. The internal rate of return is very simply, which I'm going to try to make it simple for you to understand in context, is and bear with me because I'm going to use some rounding just so we're not getting too lost in the weeds. But if you said right now that if you made a $100,000 investment and after 1 year you were returned $120,000, Your return or IRR is 20%. Okay, so when we're real estate investors, I can't build a building, rent out the building, refinance the building, sell the building. I can't do that in a year. Okay, so all of us as investors, take into consideration a hold period. Okay, so a hold period and the IRR model takes into account, thank you, Peter. IRR model takes into account time. Time is a very, very important part of the IRR model. What and how long? So if someone says to you that I'm going to give you a 13% IRR with a hold period of 10 years, they're projecting that each year for those 10 years, you're going to earn 13%. An IRR model is showing you that you're going to earn 20% return. So what is your threshold? So we at F Street try to produce high double-digit IRRs and even into the 20s as permissible threshold for IRRs. We generally use a 4 to 5 year hold period. But as an investor, do you want to be in a deal for short-term or long-term? What's important to you? Do you want to get your money back? Do you want to plant a tree and have all your money back in your pocket? Here's $100,000. Here's the $100,000 back, and you want to own your equity for the rest of your life? I have investments that have been running for 15 years. Every single month for the past 15 years, my investors are getting paid. Now, interestingly enough, in those investments, I very rarely hear from the investor saying, well, are we selling the asset? Hey, what's going on? Because every month they're getting a really nice return. So most of the time, despite all of the nonsense, this is Wall Street, by the way. IRR has to be 21%. IRR, because Wall Street doesn't care about taxation to you, the investor. They want to produce as much cash, irrespective of taxes, as they can, because that makes them feel good. I have a 24% IRR on that deal. But do you really? And does that make sense? So IRR is one of the largest calculators that is out there that people use, but take a look at what IRR is from a hold period for threshold. Do you want to be in an investment for 7 years? Do you want to be in an investment for 3 years? What's the hold period, and how are they going to get you your money back? As a simpleton, as a simple guy who always had no money when I got in real estate, I needed the money I made the investment in 123 Main Street. I needed that money back tomorrow so I could make an investment in 1234 Main Street. Well, to do that, I had to keep putting returns together. How investors use IRR. The internal rate of return provides a quick profitability snapshot for investors. That's as simple as that. The IRR is going to equal 17, 18, 20, 21%. Figure out where you are. What's your buy box? What makes sense for you, the investor, to be investing in? The problem with IRR, which we're going to talk about, is it can get manipulated to show a IRR in favor of what would be a non-realistic pro forma. Right? I'm going to see 14% rent growth. Well, you saw that in Miami, and you saw that in Fort Lauderdale. The problem is, as supply continues to go up, demand is coming down, rental growth is going to start going down or being curtailed. So you cannot project a 12% rent increase every year for 5 years and expect that to actually make sense, because that's how you're going to get a 24% IRR. Well, you're going to be very surprised when it comes in at a 14 or a 16, and you're going to say, geez, was that risk worth it? Because I had a very unfavorable pro forma that got me to an unfavorable IRR projection. Remember, every investment that's being shared with you, it's a projected IRR. We can't tell you what it is until I prove it out. I got to actually do the doing. I've got to do the math to get you the IRR. So as you can imagine, people can give the bullish lens, right? I can give you this lens that says, hey, this is going to be a 32% IRR. No way. I'm never going to achieve that. So be mindful, fall within the delta, right? 16 to 22%. That's within the wheelhouse. Well, then everyone's going to say, well, why would you ever do a 16 when you can do a 22? It's all about risk. It's all about risk. What are they projecting the 22 to be on? Higher IRR doesn't always mean better. Balance risk. Okay? Hope that makes sense. So, equity multiplier. The equity multiplier, the question mark meant to say multiplier. So, okay. What is equity multiplier? What is an equity multiplier? An equity multiplier is simply total cash distributions divided by your equity contribution. If you put in $200,000, if you put in $100,000 to get back $200,000, you can do the math, right? You understand what it is. Equity multiplier is calculated as the total cash received divided by the total equity invested, a snapshot of profitability. So equity multiplier is another number. When you see a 2x or a 2.02x or a 1.76x, what are you getting? If you put in $100,000 and you get back $176,000, you have a 1.76 equity multiplier. Then you need to ask yourself, in how long of a period? How much time? What's the time horizon? Time. And that can be anywhere from 1 to 5 years. What makes sense to you under the equity multiplier that's permissible to you? For me, I like to see a 1.7 to 2.2 equity multiplier. That's me personally. When I look at investments, I want to be in that threshold. So how do you use the equity multiplier? Equity multiplier shows profitability, but it must be paired with the time that we discussed, right? Time sensitive. Account for timeline, 2x equity multiplier over 5 years is a whole different animal than 2x over 10 years. You're basically earning the same amount of money twice, but it's taking you twice as long. Doesn't make sense. So when you start digging in, if somebody says it's a 2x multiplier, your first question should be, what's the hold period? And how are you going to execute on that? Well, we're going to build it, and then we're going to test it, and you'll see all these crazy statements, and you're like, well, A, B, C, D, and E all have to happen? Wow, that doesn't seem very reasonable. Versus, I'm going to build the building, I'm going to rent the building, I'm going to sell the building. Okay, I can do those. I'm going to build the building, I'm going to rent the building, I'm going to refinance the building, then I'm going to sell the building. Okay, I can understand that too. So the other one that we use all the time is cash on cash. What is cash on cash return? It's your annual pre-tax cash flow divided by your equity investment. Gets you to your cash on cash return. What are you actually getting back in terms of money in your pocket? That's important. How much are you getting? Are you getting distributions? Are you getting money? Is it coming into your pocket? Are you getting it? What does it look like? We're just closing on Grainger. The cash on cash return, I believe, is an 8% cash on cash return based on the in-place income that's happening. I can pro forma that. For me, permissible is 7 to 9% cash on cash in year one. Because as the investment gets better, as the lease happens, as the rental rate goes up, your cash on cash should go up. Cash on cash for F Street is based on outstanding equity and improves as the capital is returned. So as we're paying you down, principal reduction, I'm trying to get you your money back. Your money tree's planted. I want you to plant another one with F Street. Your cash on cash is going to go up. You have less invested. So what are the impacts of cash on cash returns? Construction projects, cash on cash is often zero during the build phase. We don't have any income, right? You can all understand that. If I don't have any income, I can't pay out. Stabilized acquisitions, like we're talking about, we're closing on Grainger on Friday, often delivers consistent cash on cash. And then planning for liquidity. Understand the sponsor's plan for returning the capital and align with the cash on cash short-term and long-term goals. Where do you fit in this category? Are you a high earner right now? And if you got another $8,000 a year on your $100,000, it doesn't matter? Yeah, construction projects might be for you. If you're a retiree or if you're soon to be retiring or if you've got cash flow needs in your life, You might want stabilized acquisition capital where you're getting cash flow consistent and it's due immediately. The private debt fund pays every month. You want money? It's paying. It's paid for the last 16 years. So using core metrics together, how do you use all this together? How do you evaluate as an investor what is good and what is bad? How do I make sense of all this? Because we throw all of this at everybody, right? Because this is now the new norm. It's almost like, let me confuse the crap out of you. And then once you're confused, you're going to pick up on something and then figure out maybe this is right for me or maybe it isn't. And to me, that's so frustrating. We use it. I use all of this. All of this. I'm telling you every day, all of our PPMs, all of our offering memorandums, what our IRR, our equity multiplier, our COC, the timing, your risk. I'm like, well, how can Mr. Doctor or neurosurgeon or this person or that person or attorney or mother or father, how do they even know? And the answer is they really don't. Right? We have some people say, yes, I made this blind investment in my 401k. I made this investment but they don't understand it. I want you to understand it. Ask the questions. How does it impact you? How does it make you feel when you have risk associated with each of these items? For me, it's all about risk. How many people sleep good at night right now? How many people would feel good if they made $1 million investment tomorrow and didn't fully understand it? It happens every day. I hear about them. I hear the horror stories, the good and the bad. I made an investment in this stock, this annuity. Talked to this young lady, nice lady. She made an investment in an annuity. She was promised money from a very large company, and somehow it's not working out. She's very frustrated, and she did all of her diligence. She's very competent, highly educated. And I said, I wish I could have been there at the time, but I'm not there because I want to just be a sounding board. I want to answer your question. I want to give you the real spin on life. So we use these together, right? Ground up, construction scenario, stabilize, right? So think about it. Let's just say you're looking at two opportunities, A, B. The IRR is high 20%, high. The multiplier is high, 2x. Cash on cash is low. Remember, I'm building this building. Returns are delayed, primary project, and higher execution dependent on successful exit. This is a more risky proposition. I've got to buy it, build it, lease it, stabilize it, refinance it. And under scenario A or 1, I got to do all of those things. Now, when I do all of those things, the upside, the risk should equal the reward if you're with the right parties, if you're with the right sponsor. On our stabilized acquisitions, you're getting a moderate IRR. It's much lower. You're getting an equity multiplier that's much lower. Your cash on cash is in that 8% range right away, and the returns start right away. You're going to get a check. For those people that invested in our deal, Granger, that's closing, Granger's closing on Friday, expect an immediate check. Guess when else to expect one? Every single month. Your investment is coming in and earning money day one. Okay, using core metrics together, right? So this is kind of like the symphony, right? So you have to evaluate that if you're investing in real estate is inherently a illiquid investment, meaning it's not something you could turn into a stock and turn it into cash tomorrow. So you have to plan for yourself. So what's your horizon on timing? How far out do you want to go? This is 3, 5, 7 years. Where are you? Are you in the prime right now where you're earning high? And you don't need money for 1, 3, 5, 7 years? Make the longer term investments. Great question. So the question is, how do you attest to see if the IRR model is realistic? So at the end of the day, the X's and O's, when we break down everything, really comes down to NOI and cash flow and assumptions. Okay? So think about it like this. When I do a multifamily deal, the first thing I do traditionally is I do a market study. I pay a third party to come help me determine what the rents are going to be. If the rents are projected based on my study, which is a study of comparables at, let's just say $2 a foot. Okay? Let's just say that, okay? Let's assume that for the sake of assumption. If you want to see my study, by the way, I'll give it to you. Ask, how did you get to your revenue projections? Because I invest in Albany, New York, and I invest in Milwaukee, Wisconsin, and candidly, a studio in Albany, New York goes for almost what a bedroom, one bedroom in Milwaukee goes for. Totally different markets. So I asked that question, how do you determine your revenue? And so if somebody says, well, market is projected at $2 and they're projecting year one rent at $250, they're 22% higher, 23% higher already, 22%. How are they even getting there? They're already elevating rent and setting everyone up for disappointment. The next part of it is concessions, right? Oh, rent's gonna be $250, but I'm gonna give you 3 months free rent. Well, you might as well just lower the rent to $2 that you thought you were gonna get. And so so you have to really look at, it's a long-winded question, a long-winded answer to a really great question, is you have to evaluate the income or whatever the modeling is being used to determine what the income is and how close they are to get to that number. So the better question is, in your previous project, how close were you to achieving projected rents? Because if you were 100% or 105%, the chances of you achieving rents on this one are going to be the same. High. You're going to be equal to success. That doesn't mean that you're going to say, oh, I'm going to get X for rents and you get X minus a percentage. That to me is death. And then the second side of that is obviously the expenses, right? If I'm projecting that my cash flow or my NNOI is going to be X, I got to be close to it. Well, if your revenue's off and your expenses are too high, you're screwed. A lot of people don't take into account or consideration taxes and insurance increases. So you got to really dig into that. So investment structure. Also understanding what the waterfall scenario is, what's the payback period, and the investment hurdles. A lot of people create all these crazy hurdles. We try to keep it super simple. That's the way we operate. I love to operate that way because it's good for you, the investor, because you can understand how simple I'm going to make it. I've seen hurdles that have 50 different benchmarks that make life incredibly complicated. So at F Street, here's our model. It's pretty simple for waterfall structure. I have a simple model. I'm going to pay you a preferred return. All of the cash flow is going to go back to the investor until you're repaid. Okay, it's just simple. I have enough opportunities and enough real estate in our world that I am committed to you, the investor, to get you your money back. Some people say, well, I don't want that. I don't understand it. Well, think about it like this as an investment. If you borrowed money to your friend, your son, and you said to them, I want you to pay me back. You want them to pay you back? Yeah, of course you do. We want them to pay you back. When you make an investment with us or anybody, don't you want your money back? Yeah, of course you do. Think about that. I'm giving you 100% of your money, of the free cash flow, 100%. So by the time you have received 100% of your money back, plus your preferred return, plus these two items, you've got zero skin in the game. You are playing with house money. You ever heard of house money at the casino? Well, I went to the casino, I won $1,000. I put my $1,000 back in my pocket, I'm playing with their money, right? How many people have done that? I love doing that in Vegas. I'm not a big gambler, but I love playing with the Bellagio's money or whatever casino I'm at. Anyone else like to play with the house money? So once you have all your money back, now you're with house money. Now you're getting 50% or 60%. Our spread shifts anywhere from 40 to 60%, 40 to 50% to the investor, 40 to 60% of the investor, and vice versa. But I'm giving you all of the cash flow and all of your money back. I de-risk you every day. Every month I pay you back your money, you are de-risked. Who likes to be de-risked and own their equity? Your equity is always yours. All of the time. So the question is, what other debt obligations might come before you in a waterfall? So those are great questions you should be asking. You should figure out who is your senior lender. Are there any other preferred debt, any other sub debt? Are there any other people in the waterfall that would have any preference to me, which could be a preferred return holder? The other way to look at it is under the operating agreement that you would subscribe to, there are various different shareholders, Class A, Class B, Class C. Each one of those has a priority, and you need to figure out where you are in that category. I'm going to grab a quick sip of water. Okay, what is a preferred return? We just talked about where you sit in the waterfall. A preferred return or a preference is important in terms of the Class A, Class B, Class C shares, where you are. When we issue a preferred return, let's just say it's 7-8%, it goes on senior debt, then preferred in the waterfall, before anybody GP shares in any profits. So you need to make sure, in my opinion, you want to make sure that your preference is well articulated and well established in the waterfall. The preferred return is a prioritization, a preference of investors' return, providing a layer of security and aligning incentives with me, the sponsor, with you, the investor. When you invest your hard-earned money, it is the greatest compliment and the biggest concern and responsibility that I have every single day. You worked so hard. Some people work years to make an investment. Some people work months, days, whatever it is in your world, but you choose to make an investment. That responsibility and fiduciary is huge to me. So I have to make sure that I am delivering on returns and a pro forma that makes sense. I've been here for 20 years. I'm going to be here for another 20. I know that I won't be here for another 20 if I don't take care of the investor. We don't raise $60, $70 million a year without being successful. It doesn't happen. And then they ask the questions. Is it cumulative? At what point does the GP participate? Are there fees impacting the effective return? When you start looking at these fees, you'll start seeing there's disposition fees and acquisition fees and asset management fees, and all of that is just chipping away at the returns. Evaluating the waterfall structure. Understand where you are. If you don't know where you are in the deal, you need to know. This is a very important piece of it. Ask, understand, know. Ask, understand, know. Understand your position in the investment. Are you Class A equity? Does your Class A equity have a preference? Do you have a priority? Where are you in the waterfall? Ask that question. Ensure the GPs, me, general partners, are incentivized to perform well and not prioritize my profits over yours, or anybody's for that matter. What are the splits? When do you get paid back your money? Who gets paid back first, etc. You good? Capital payback period. Time to record. Hold on. It's shifting when you're moving. Sorry. Oh, let's do it again. Okay. Time to recover. Measure how quickly your initial investment is returned, reducing your risk and improving your flexibility. For me as the GP, I want to make sure you're getting repaid your money. That's my number one priority. Other people want to give you the highest returns. I want to make sure that your principal that you have is getting back to you plus your preferred return in a timely fashion. Think about that. My number one priority is to make sure that you, the investor, get your money you've invested plus your priority return back to you as fast as possible. I'm incentivized to do that because then I share with you. Faster payback enhances liquidity. Slower payback may align with higher equity multipliers. When is your capital returned? Ask the question. And how does the payback period align with the metrics like IRR and cash on cash? How does it happen? Ask the questions. What's your term? What's your terminology? Is it zero? Is it all the way through ongoing? Are you ever getting paid back? Are you just getting a preferred return? How do I get my money back? Okay, what are investment hurdles? They use this all the time. This stuff drives me crazy, to be honest with you, but everyone uses it. Hurdles are just basically thresholds that I have to jump over, which allows me to earn more money. Me, the GP, you, the investor, it kind of reduces your position sometimes, or it caps it. Well, after I earn 12%, I share 22%. Then after I earn 13, I earn 14. Holy hell, by the time you are able to solve for the waterfall of the investment hurdles, you might as well be a neurosurgeon. Any neurosurgeons on there? I think you're very smart. This, to me, is so convoluted that nobody can understand it. And as the result of it, some people just say, oh, just throw some money in there. Why? But okay, our hurdles are very simple, that we don't have hurdles. We give you 100% of your money back. After you have your money back plus your preferred return, you own your equity. It's that simple. I can't make it any more simple. The reason I do it is because I want to be able to sell it to you so you understand it. It's simple. So putting it all together, comprehensive evaluation, ask the questions, use IRR, equity multipliers, cash on cash, investment structures together, assessing profitability, liquidity, and risk. Where do you want to be in the future? And what is your risk tolerance? And then balance metrics wisely. Don't look at something on its face value because the shiny object says 28% IRR and believe it. Because I can promise you're going to be let down. It doesn't make sense to me. How can it make sense to you? How can someone achieve a 28% IRR? I don't know, unless they're buying it for nothing and building it for nothing and renting it for $1 billion. How does it work? And then what I always tell people, which is this is pretty important, is build your strategy, understand your structure, and balance wisely. Do all of that. You're an investor, and I don't take this for granted, but understanding how much people are investing is the most important part of your end career, right? Some people want to do it for their generational family. Some people want to do it for their grandkids. Some people want to invest for their retirement. Some people want to invest for their quality of life. Make a plan. For darn's sake, make a plan. I'm not telling you that you should only be in alternative investments. I'm not ever saying that. I have stocks. I make investments in alternative investments. I invest in everything I'm doing, but I also have a plan. I want you to have a plan. Take a spreadsheet, a G sheet. I use it every day. My own little plan. I call it Project Crush It. What's your plan called? Project Crush It too? Do it. Awesome. Figure out where you're going to make your investments. What's your returns going to be? What's your cash flow going to be? How much investment do you need today? How much return do you need today? How much do you need in a year, 3 years, 5 years, 7 years? If you sat down today and in 3, 5, 7 years, in 2030, 2031, you're going to be like, wow, I achieved my goals, or this isn't working and this worked. Or after year 3, you can pivot after you see what did and didn't work. So I'm going to run through a few open opportunities with F Street. We're running close tight on time, and I want to leave it open for a little Q&A. So I'm going to breeze through these a little bit. If you have any other questions, please let me know. Just want to give you a couple opportunities. Phase 2 is launched, F Street OCLV. We just broke ground on F Street OCLV MF2. We're projecting on this one an 18.42 multiplier. Remember what I told everyone? Based on a 5-year hold. This one's a 5-year hold, projected cash on cash. Everyone knows what that means now. And everyone knows what an equity multiplier of 2.01 means based on a 5-year hold. You put in 100 grand, in 5 years, you should expect $201,000. This deal structure, it's an 8% preferred return with a 65-35 split to the investor. Industrial acquisitions, we're working on a lot of acquisitions. We will be delivering 10 to 20 high-profile, high-potential properties in the Midwest Industrial Hub this in 2025. We've got 3 we're working on. I just got a 900,000 square foot building under contract 5 minutes ago before I came here, so now that's about an hour ago. I've got 3 other deals we're working on. Industrial, to me, is one of the greatest asset classes, and it always has been, and it continues to get its notoriety, but there's a lot of risk still there. We're working on increasing cash flow. We're working on NOIs. We're working on driving rents. We're working on finding better tenants. And we're working on improving assets. Consider making an investment in industrial. This is my, I don't know, I call it my little baby, but it's really our private debt fund. It's been around since 2009. We've been paying 10% return every month. I pay this every month. I pay 1/12 of 10% each month, every month. We're almost on our 16th year. I've never missed a payment. We pay 10%. I've got people that invest $50,000 to $10 million. We've added $24 million in 2024. We're going to add another $24 million in 2025. Demand is off the charts in this debt fund. It's really simple. We pay you 10%. We pay it to you monthly. We do have an ability to compound. Earn your badge. We register all of our investments with the SEC, or the Security Exchange Commission, under the 506C. The 506C is a accreditation process that requires you, the investor, to earn $200,000 as an individual a year, or $300,000 as a family, and or have a net worth of $1 million, excluding your residential home. The SEC requires us under our Form D filings, since we advertise, that you have to get accredited by a third party. We have a system that takes you through all of that on our website at fstreet.com. You can earn your badge, which is an accreditation badge that lasts for 5 years. And once you're accredited, you can invest in all of our opportunities. To do this, it's free. It costs you nothing. If you want to get your accreditation with us, you can use it with anyone else. It's free. It doesn't cost you $1. So let's invest together. If we have any questions, I'd like to answer those this evening. I want to once again thank you for considering F Street. Thank you for bettering yourself. Thank you for learning about alternative investments. I hope I've been ability to answer. I hope I provided the ability to answer some of your questions, and I really appreciate you being here. Thank you. Peter, what's up? Yeah, I mean, it's a great question. The question is, how do you affiliate fees, and how do you know if people are in cahoots with other people, and if they're paying themselves, and all these other things? It happens every day. I don't know how else to tell you. How do you know if Charles Schwab is getting paid from its Vanguard fund, and et cetera, et cetera? They all get paid. It's all convoluted. Honestly, it's kind of frustrating. At the end of the day, I look at it like this. You're investing in a sponsor. When you choose to invest in F Street, you're investing in Scott, you're investing in my team, you're investing in my partners, you're investing in our business. And for that, I don't take it lightly, and I have to continue to earn your trust every single day. So I need to work hard to make sure that you're trusting me and that we're doing a good job for you, the investor. So the fee structures are out there. We disclose everything in our memorandums. We have a third party. We do not get kickbacks. None of that happens. But it happens in our industry. And so, you can ask the questions, you can read the disclosures. They're so convoluted and so complicated. You really need to make sure you're investing, in my opinion, with the right people, and the people that you can trust, and you can earn their trust, and they can earn your trust. And that's really the important way to be selective and to be successful. Sure. So the question is, can F Street provide any references, specifically a real estate attorney and or other credible individuals in the industry? So we Absolutely. Right now, if you were to ask for references, we provide a list of references, which are people that are current investors of ours that have been investors for multiple periods of time that range from $100,000 to well over a couple $1,000,000. You can talk to them, ask them their experience. If you'd like to talk to our attorneys or our accountants, they're available as well. We're a very open, transparent book. We'd love to have you involved. We'd love to earn your trust, and whatever it is to earn that for you, we will be sure to provide you with that transparency. Super easy to do. We already have investors that have agreed to be part of it, and we're happy to share those with you. In addition to that, if you go to our Google reviews under fstreet.com, you will be able to see the slurry of really positive reviews from our investors that have taken the time out of their day to write a credible review for us, and you can talk to them as well. Sure. So the question is, can you go back to OCLV MF3, review the investment, and how else has this site done? I'm going to do it a little quickly. If you'd like to go through it more in person, I'd love to run you through this. Yes. OCLV stands for Oak Creek Lake Vista. We are developing a 66-acre planned use development. We've just completed the 199 units. We've completed townhomes. The townhomes are almost completed. We're at 50% occupancy today. The 199 units is at 95% occupied. We have just broken ground on phase 1 or MF2, and MF3 sits right next to it. Demand for housing, rental housing has been off the charts. We are 8 months ahead of schedule. We've already commenced our first distribution out of MF1. Overall, we're doing incredibly well. The site is right on the beautiful shores of Lake Michigan in Oak Creek, Wisconsin. OC Lakeshore is the website if you want to kind of see what it looks like. But overall, this is one of our greatest developments, and we're really proud of it. And the demand over here just continues to be remarkable. So really proud of this investment. It's on our website, fstreet.com is our offering memorandum. You can go there right now, download it. You can see all of our sensitivity analysis. You can see all of our pro formas. Let's talk. What if construction is delayed? So construction is a byproduct of us raising our equity, which we're in the process of doing, and securing our loan, which we've already done. We've just phased this out. So phase 1 has already started. Phase 2 will start in March or April. We're going to be within a month of those dates. Construction is not going to be delayed. We already have CDs and permits, so we're ready to roll. So the question is, what's our current cash on cash for our industrial fund? We do not have a fund currently. The reason we do not is that we allow the investor to invest in each specific deal as it stands. So each deal has its own metrics and own cash on cash returns. We traditionally, is this Granger you have up here? Yeah, so this is Granger. This is closing on Friday. So we're projecting an 8.83 cash on cash return in year 1 and an 11% cash on cash return in 2028. So this deal's fully funded. We've raised $3.5 million. We're closing on Friday. And so this is what we're projecting the cash on cash returns will be. Each deal has its own merit. So this one should be into the 11s in 4 years. And this is based on what we anticipate being a great acquisition for us with immediate cash flow starting month 1. So every dollar that we invest goes to the specific project. So as we describe any deal, we don't have a fund, as I mentioned. So when we raise $6.35 million here, all $6.35 million goes into that entity, F Street OCLV MF2, for the specific purpose of building that building. So we don't do funds, and we don't have deployment issues when we only take the money for the project. And once we have the project, we fund it and we close on it. So we do not offer a fund. We are only a special purpose entity investment where you can say, I like that one or I don't like that one. Good? All right. This was a wonderful conversation, guys. I'm so grateful for your time. As I said, taking the time to better yourself, better your investments, and better your plan. I hope you all create a project, crush it, so you can get ready to crush it with your alternative investments. I'm grateful to have you here. If you have any other questions, you can reach me on Instagram, or you can reach me at scott@fstreet.com. Visit our website. We are transparent and we love to communicate. So we will be in touch. I promise you. Thanks for being here. Thanks for being part of our community. Thanks for being part of the alternative investment community. And I'm really grateful for your time. Thank you so much. And once again, my name is Scott Lurie with F Street, and I hope to see you soon.